Okay, so any questions so far? Okay, good. Now, this policy works for a mortgage protection, and I'll tell you why. See, on a 30-year mortgage, you and I are going to end up paying almost 3 times whatever we borrow because of compound interest. Now, I'm sorry, you have a $150,000 mortgage, you're going to end up paying almost $450,000 if you keep your mortgage for 30 years. Chances are you're not going to keep it for 30 years, but any financial consultant will tell you that if you make one extra payment a year, you can cut your mortgage from 30 years to 20 years by just sending one extra payment a year. Okay? Have you heard about that? Okay. Or also bi-weekly. It's the same concept. Now, what's your mortgage payment at this time? 1200. Okay. Are you sending any extra money towards the principal or not? No? Okay. Have you thought about it? Yes? Okay. Now, most of the people think about it, and the concept really actually it makes sense, but we show you a better way to do that. Most of the people think it's a benefit to send extra money towards the bank, and we tell you don't do that. Why? Just to humor me with this example. Let's say you send $100 extra. That instead of $1,200, your payment now is $1,300. If you do that $100 a month for the next 12 months, you deposited exactly one extra payment towards your mortgage. Now let's say you do that for the next 10 years. Okay? You deposited out of your pocket $12,000 into your mortgage. Okay? Now, let's say you need that money for whatever reason. You need a new car, new roof, your kids want to go to college, and you need that money. You think the bank's going to give you that money back? Hey, you say, call bank. Hey, Mr. Bank, I have been sending you that extra money. I need it now. They're not going to give it back to you. So you basically lose control of that money. Because the day you send one extra penny into the mortgage, it becomes part of your equity. The day you need that money, yeah, you can get it as a second mortgage or a home equity line of credit, which in this type of market is almost impossible to get. Also, just to have in mind, you wanted to pay your mortgage off sooner by sending that extra money. The day you need that money, now you ended up with 2 mortgages. So you just defeated the purpose of that. Second disadvantage of sending that extra money towards the bank is you lose your tax break. Because on a 30-year mortgage, the next 20 years, everything that you pay in interest in this house is fully tax deductible. Now, if you cut your mortgage to 21 years because you are sending that extra money towards the bank, yeah, you're accelerating the mortgage, but at the same time, you're accelerating the interest on that mortgage. After 10 years, what happens is you have no more interest to deduct. So your taxes are going to go based on a higher amount. Just to give you an example, let's say you make $50,000 a year in income and you pay $8,000 in interest for this mortgage, you're only going to pay taxes on $42,000. Once you don't have this interest because you are accelerating that mortgage, your taxes are going to go based on a higher amount. So what we tell you the Hartford is do not send that extra money towards the bank. Send it to the Hartford and we'll show you 4 reasons why. Did I explain myself so far? Yes? Now, the mortgage right now that you have is $130,000. I'm sorry, $150,000 for that matter. Okay? Now, our product starts at 0 at 5% interest. So, your mortgage start here, you pay your mortgage every month. Whatever you send in to us to insure that mortgage is increasing of 5% in interest. So this is going higher and this is coming lower. At some point they're going to meet, meaning whatever money you have in cash value is exactly how much you owe to the bank. At that time you take all that money and pay the bank in one payment. By doing that, you just got rid of your biggest debt. Okay? So instead of paying the mortgage off through the bank, you can pay it with us. You can still pay the mortgage off sooner. And also, you're able to keep your tax breaks because of the interest on that mortgage is still fully deductible. The second benefit of sending the money to us instead of the bank, if you ever needed a loan, we can give it to you at 2%, no questions asked. If you don't pay the loan back to us, we don't care. We're going to give you the death benefit upon death minus the loan you had against the policy. Whether on the bank side, if you don't pay the bank, you need that money. You need take a loan against your mortgage. You take a second mortgage, right? If you don't pay that second mortgage, you lose your house. Okay? The third benefit is if you move. If you move, you basically take your policy with you to your new mortgage. If it's higher or lower, you adjust it. Okay? The only thing is, the beauty of this is whatever cash you build in that policy, it will follow you. Whether on the bank side, if you keep paying that extra mortgage payment to your bank, it becomes part of your equity. As you've seen in the market nowadays, the real estate market came down, so people actually lost equity. So with us, you will never lose that because it will follow you to your new mortgage. And the last thing is in case of a death. God forbid something happens to you and you were to die at some point. The bank really doesn't care what happens to you. If you have a mortgage for $150,000 and you were to die, God forbid, and you send $10,000 extra, the bank is gonna tell your wife, you know what? We're really sorry that your husband passed away. He sent us $10,000 extra. The mortgage is still $140,000. You still have a debt. So that's the point. If you send extra money towards the bank, they're not gonna give the house to your wife. They're just gonna go after her. With the Hartford, for the same money you send it to the bank, you send it to us, and you were happen to pass away, the house is paid. Now that's the worst case. Of course, nobody wants to think about death, but it's inevitable. You're gonna die, I'm gonna die. See, when it comes to death, it's when it happens, not if or but. It will happen. There's two certain things in this world: death and taxes. We can control the death with this policy. Taxes, well, that's the government. But just to give you an idea, if you were to pass away with this policy, your wife will be taken care of. Now, let's be optimistic for a minute. Let's say nothing happens to you, everything is fine. You just accumulate so much cash value that you can take that money at any time. So if nothing happens, you get your money back. If something happens, your house is paid. You see, this is much better instrument to send the money to the Hartford, have the insurance, and have access to the money than sending it to the bank, having no insurance and no access. Okay? Did I explain myself here? Okay. Now let me ask you, Mrs. Wife, how many months can you afford this mortgage without your husband's income? Let's say something happens, he cannot make it next week. How many months can you afford it? 2 months? Now all the way around, how many months can you afford it if your wife's not here? Around the same? 2 months? See, the reason we ask this is right now we need to determine who really needs the protection. And like most of my clients, both of you need the protection because both of you bring money to the table. Okay? Did I explain myself here so far? Good.